Right now, at this very second, Circle Internet Group Inc., ticker symbol CRCL, is trading at exactly 77.13 USD, pushing up by 0.54 points or roughly 0.71% on the intraday chart. If you are watching the order book, you are seeing a classic tug-of-war between retail hesitation and institutional accumulation, and that green flicker on your screen is hiding a much more aggressive story than the headline numbers suggest. Most investors looking at this chart see a company recovering from a post-earnings dip, trying to find a floor after the volatility we saw last week. That is the expectation, a simple technical bounce for a stablecoin issuer that recently went public. But here is the reality that requires you to lean in closer. Circle is not trading like a utility stock or a boring bank anymore. It is trading like a volatility index for the velocity of money itself. And the movement we are seeing today is likely the smart money positioning itself ahead of the fireside chat at Citi's FinTech conference tomorrow. While the retail crowd is obsessing over the insider selling headlines from a few days ago, the tape is telling us that the big hands are quietly stepping in at these levels, betting that the market has fundamentally misunderstood the interest rate sensitivity narrative that drove the stock down from the high 90s. When you look at the price action of Circle Internet Group today, sitting there at $77.13, you have to contextualize it against the broader tech sector. If you pull up Tesla stock or Nvidia stock on your side monitors, you see them reacting to completely different macro stimuli, mainly AI capex and consumer demand. Circle is detaching from that correlation. It is moving based on the plumbing of the global financial system. The volume we are seeing this morning, already creeping past 4.5 million shares, suggests that the weak hands who panicked after the Q3 earnings report have largely exited. Remember, Circle reported revenue of $740 million, beating expectations, yet the stock sold off. Why? Because investors are terrified that if the Fed cuts rates in 2026, Circle's interest income on its massive reserve pile will vanish. That is the fear. But the contrarian take, the one that explains why we are green today, is that lower rates ignite transaction velocity. If money is cheap, it moves faster, and Circle takes a cut of that movement. You are buying a toll booth on the internet's economy, not just a savings account. This is where the psychology of the average investor gets tested. You might be looking at your Robinhood app or checking your balance on SoFi Invest, seeing that red week on the chart and feeling the urge to cut losses. That is natural. But let's break down what is actually happening with the flow. We saw a director, Patrick Sean Neville, sell about $2.85 million worth of stock last week. When retail investors see insider sell on their newsfeed, they instinctively hit the sell button. It feels like a red flag. But if you analyze the Form 4 filings, that sale was a fraction of the holdings, and often these are pre-scheduled programmatic sales for tax purposes. The market overreacted to a standard administrative move, creating an artificial discount that we are seeing get bid up right now. If you are using Interactive Brokers or a similar professional platform, look at the block trades coming in above the ask price. Those aren't retail traders buying 50 shares. Those are institutional blocks absorbing the float. Let's talk about the structural argument for this stock. Most people think of Circle as the crypto dollar company. That is the expectation, that it lives and dies with Bitcoin prices. The reality is that Circle is becoming the settlement layer for traditional finance. We are talking about BlackRock using Circle's infrastructure. We are seeing Fidelity Investments and Fidelity Wealth Management clients starting to ask about how digital dollars fit into a diversified portfolio, not as a speculation, but as a cash management tool. The disconnect between the crypto casino perception and the financial infrastructure reality is where the alpha is sitting. If you are managing your own capital through Schwab Intelligent Portfolios or handling an individual brokerage account, you have to ask yourself if you are pricing Circle as a tech stock or a bank. The market is currently confused, pricing it somewhere in between, which causes these violent swings we have seen between $75 and $80 over the last few sessions. I want you to pause for a second and think about your own portfolio. Comment below how many shares of Circle Internet Group you currently hold, or if you are waiting for it to drop back to the low 70s before you enter. I am genuinely curious to see where the sentiment is among individual investors, because the sentiment metrics I am seeing on social platforms are incredibly bearish, which is often a contrarian buy signal. Now, let's look at the financials that came out recently, because they paint a picture of a fortress balance sheet. They are sitting on over $12 billion in cash and reserves. This is not a cash-burning startup hoping to turn a profit in 2030. They are printing cash right now. The adjusted EBITDA came in at $166 million for the quarter. For a company growing its transaction volume by triple digits year over year, that level of profitability is rare. Usually, you get growth or profit. Circle is giving you both. The bear case is that this profitability is fake because it comes from high interest rates on their treasury holdings. They say, oh, once rates go to 3%, Circle's earnings collapse. This is the single biggest misconception driving the price today. If rates drop, the yield on their reserves drops, yes, but historically, when rates drop, crypto activity and stablecoin circulation explode. The supply of USDC grew 108% year over year. If that supply doubles again because risk assets become attractive in a low-rate environment, the volume fees will dwarf the loss in interest income. We also need to discuss the competitive landscape, because you can't talk about Circle without mentioning the elephants in the room. You have PayPal with their PUSD, and you have the offshore giant Tether. Investors worry that PayPal, which many of you might hold in your Robinhood investments or Fidelity ETFs, will crush Circle with its distribution. But here's the nuance. PayPal is a walled garden. Circle is an open protocol. It's the difference between AOL and the open internet. Developers are building on top of Circle. They aren't building on top of PayPal in the same way. This is why the launch of the Arc platform in October 2025 was so critical. Arc is Circle's attempt to build an economic operating system that makes it easy for businesses to use stablecoins without knowing they are using blockchains. If Arc succeeds, Circle becomes a SaaS company, not just a money issuer. That multiple expansion hasn't happened yet. The stock is trading at a multiple that suggests it's a risky bank, not a high-growth software firm. Let's look at who is actually buying this stock. We have seen analyst upgrades from Baird, slapping a $110 price target on it, while Needham is sitting out there with a $190 target. That is a massive upside from $77.13. When you see a spread that wide between the current price and the analyst targets, it usually means the street is waiting for a de-risking event. That event might be the fireside chat tomorrow at the Citi conference. Jeremy Allaire, the CEO, is going to be on stage. If he drops any hints about a partnership with a major payment processor or gives favorable guidance on the regulatory front, this stock could gap up overnight. We have seen how sensitive Tesla stock or Apple stock can be to CEO comments. Circle is even more sensitive because it's a younger public company with a smaller float. For those of you who use online investing platforms to manage your retirement, perhaps through Fidelity IRAs or Fidelity mutual funds, you know that allocating to FinTech can be dangerous. Look at what happened to Block or PayPal in 2022. But Circle has a unique defensive characteristic. It is fully reserved. Unlike a fractional reserve bank that can suffer a run, Circle holds the cash. This makes it, ironically, safer than the regional banks that trade at higher multiples. The market hasn't fully digested this safety profile yet. They still view it through the lens of the 2022 crypto winter. But we are in late 2025. The regulatory framework is clearer. The institutional adoption is real. Speaking of platforms, if you are trading this on Robinhood stock trading or utilizing the Robinhood cash management features, you are likely seeing the volatility firsthand. 1 minute CRCL is at 77.13, the next it dips to 76.80, then rips to 77.50. This chop is caused by high-frequency trading algorithms that are scalping the spread. For the long-term investor, this noise is irrelevant. The question is, do you believe that stablecoins will represent 5% of the global money supply in 10 years? Right now, it's a fraction of a percent. If that thesis holds, the price today is a rounding error. If you believe the government will ban them effectively, then $77 is expensive. There is also the Fidelity effect to consider. Fidelity has been incredibly pro-crypto compared to other traditional giants. Their Fidelity trading platform and Fidelity mobile app have integrated digital asset tracking aggressively. As they educate their massive boomer client base about the utility of stablecoins for settlement and yield, we could see a rotation from traditional bond funds into stablecoin infrastructure equity. Circle is the only pure-play public way to bet on that trend. You can't buy stock in